Hello everyone, welcome back to another exercise tutorial from chapter 10 of our Managerial Accounting course, ACCT 428. In this video, we're going to be looking at exercise 10-12A, so let's read the question together. It says North Airline Company is considering expanding its territory. The company has the opportunity to purchase one of two different used airplanes. The first airplane is expected to cost $12 million. It will enable the company to increase its annual cash inflow by $4 million per year. The plane is expected to have a useful life of 5 years and no salvage value. The second plane costs $24 million. It will enable the company to increase annual cash flow by $6 million per year. This plane has an 8-year useful life and a 0 salvage value. What's required here? A. Determine the payback period for each investment alternative and identify the alternative North should accept if the decision is based on the payback approach. Right. So here we want to calculate the payback period. The payback period, as we have learned in the lecture, is the duration or the number of years that it's going to take for the company to recoup or recover their initial investment. Okay? And as we said in the lecture, this metric is specifically used a lot in real estate investing. Okay? By comparing the costs of owning a real estate and then how much that real estate is expected to generate annually. The real estate investors like to calculate how long it takes them to recover their initial investment. Okay, but here we have a different scenario for the airplane. So let's run the numbers. First, I'm going to remind you of the formula that we use, which is the payback period equals the cash cost of the investment divided by the annual cash flow generated by that investment. So we'll call it the annual cash inflow. All right. So let's substitute in the formula for both alternatives. Alternative 1 For alternative 1, the airplane is going to cost $12 million and is expected to generate a cash inflow of $4 million per year. Okay? So that means we're going to say $12 million divided by $4 million. And that's going to be 3 years. All right. For alternative 2, the cost of the airplane is going to be $24 million and is expected to generate a cash inflow of $6 million per year. So we're going to say 24 million divided by $6 million. Okay. 24 divided by 6, that's 4 years. All right. So based on the payback method, excuse me, alternative 1 should be preferred. Sorry. Okay, or alternative 1 should be selected. Either way. Why? Notice that this tool is the only tool that we prefer the result to be lower. So as you can see, alternative 1 has a result of the payback period calculation of 3, which is less than the 4 that is the result of the same calculation for alternative 2, right? If you remember, for example, for net present value calculation, we prefer the highest net present value. For internal rate of return, for example, we prefer the highest internal rate of return. This is the investment that we select. But for the payback period, the shorter the period, the shorter or the lower the result we get, the better. Why? Because what does it represent? It represents how long is it going to take the company to recover their initial investment, right? So the shorter the number of years, the better for the company. That means they can recover their initial investment sooner, right? So you need to understand that. All right, so that's the answer to part A. Let's see what part B wants. It says discuss the shortcomings of using the payback method to evaluate investment opportunities. Okay. The shortcomings here are clear given the data that are in the question, right? Notice that the payback period did not consider many of the factors that should actually be taken into consideration to decide between those two airplanes. Okay, and that includes, for example, the useful life of the airplane. Notice how here, for instance, the first airplane is expected to have a useful life of 5 years with no salvage value, where the second airplane has an 8-year useful life. Okay, so it's going to serve the company for a longer time. 3 more years is not too little to be ignored. All right. Also, another thing that the payback method does not really take into consideration the time value of money concept, right? Because as you can see here, we have not done any discounting in our calculation. So we're assuming for this particular calculation that the value of $1 today is equal to $1 within the lifespan of the investment, whether that was 2, 3, 4 years, whatever. Okay, so you can put this in your own words. It doesn't really have a certain structure, but you can say something along the lines that the payback method or the payback period method ignores the duration or the life of the investment. Let's call it the life, better here. And it ignores the time value of money. And these might be the most important drawbacks or disadvantages of using the payback period. All right. Pretty straightforward, simple question. As long as you know the formula, you can directly substitute, and also as long as you know that for this particular metric, it might be the only metric that we've learned in this chapter, that the lower the final result of our calculation, the better. All right. This is how you solve exercise 10-12A. I hope that you found this video useful. If you have any questions, please drop them down in the comments, and I'll see you in another exercise video. Until then, take care.